Fed Chair Jerome Powell is speaking at the Cato Institute's 40th annual monetary conference this morning. This is the first time we will hear from Powell following his Jackson Hole speech, where he made it clear the Fed is taking aggressive action to cool inflation. Yahoo Finance's Jennifer Schonberger has more for us. Jen.
Good morning, Brian. That's right. Fed Chair Powell set to speak in a Q&A this morning before the Cato Institute. And what will be his last comments before the Federal Reserve is set to raise interest rates at its meeting on September 21st. Fed Chair Powell has struck a hawkish tone, hinting at the prospect for another large rate hike at Jackson Hole back in August. He reiterated that he said back in July that another, quote, unusually large increase could be appropriate at the September meeting, but noted that that decision will depend on the data. He's also said the Fed expects to raise rates and keep them raised at those levels. The central bank expected to raise rates by 0.75 of a percentage point at its policy meeting, which would push its benchmark interest rate above 3%, the highest level since 2008, from the current range of 2.25% to 2.5%. Fed Vice Chair Lael Brainard underscored this stance in comments Wednesday, saying that while a small drop in inflation is welcome, the Fed will still need to raise interest rates further and for as long as it takes to bring down inflation. She said, quote, monetary policy will need to be restrictive for some time to provide confidence that inflation is moving down to target. Now, Brian, the job market has remained strong, creating 315,000 jobs in the month of August, while inflation edged down a bit to 8.5% measured by the Consumer Price Index back in July from 9% in June. Officials are still awaiting a fresh read on CPI, which we will get next week, which they will take into account for how high they will officially raise rates at the next meeting. Guys?
Thank you, Jen. Appreciate it. Let's talk a little bit more here about the Fed. And not only the Fed, by the way, the ECB just raising rates today by 0.75 of a percentage point as well. So just emphasizing that there is this global tightening and attention to inflation that we are now seeing. And the Fed is obviously very much a part of that. There is more and more discussion. I mean, there's been a lot of discussion, but there's still a lot of debate about the soft landing and whether it is indeed a realistic outcome of all this tightening that we're seeing around the globe.
Yeah, it's to be determined. We were debating this morning a note out of Goldman Sachs. They are now looking for a 75 basis point rate hike at the Fed meeting in just a couple weeks. But, good point by Dennis DeButcher, a friend of our show over at 22V Research, noting that the Fed wants to slow growth, not crush it. And as long as...
that's what they want.
That's what they want. Whether what may happen is to be determined. But as long as the market thinks that the Fed is not going to just pound investors over the head and won't crush this market, maybe you won't see this big downdraft in stocks.
Christine Lagarde speaking in the press conference now following that ECB rate decision and saying, and this is maybe somewhat obvious, she said risks to the inflation outlook are primarily to the upside. And Still, and, that seems to be the case here in the U.S., even though the rate of inflation increases seems to be maybe stabilizing or even decreasing. It is still seen as such a high risk by central bankers that they need to act. There were a couple of papers that came out as part of a Brookings Institution event looking at the possibility or probability of soft landings, and both of them raised questions about whether it's realistic. They raised the specter that there will have to be a higher unemployment rate than perhaps economists and the Fed particularly are currently factoring in. And that's something also that Larry Summers and some other economists have brought up. And that's something that perhaps the market is going to have to reckon with at some point.
Yeah, Julia, I think the market still doesn't know or is not properly just pricing out or thinking about what the consumer impact is from all these Fed rate hikes. I look at me, for example. I was looking for a new car recently, and I was just surprised by some of the rates I was getting, even though, hey, I got perfect credit score. I have a job, and 7.5% rate on a car I was looking at. I mean, before pre-pandemic, that was maybe 3 or 4%. I'm not buying the car. And, I'm sure there's a lot of other people out there like me, maybe holding off on a purchase because of those higher rates, but also seeing higher balances now on their credit cards, and maybe they're pulling back more on their spending.
One more quick mention that I want to make that is sort of on a tangential topic to this, and that has to do with currencies, because we have been watching currencies so closely. as a result of the Fed tightening, the dollar's strength that we have seen, the ECB action, obviously. But I also want to say a word about the British pound because of what's going on over there. And we're going to dig more into this later in the show. But two important things happening today. One of them, Buckingham Palace has announced that Queen Elizabeth is ill. Could be a signal that she is gravely ill. So that is something that we are watching closely. And the new Prime Minister, Liz Truss, just out with a whole package designed at helping with energy costs. That's something that she had talked about, and other sort of economic incentives. So we actually have seen the pound recover a little bit from the lowest that we have seen in quite a long time. That's something, again, we're going to continue to talk about and continue to watch for any further headlines on the health of the Queen.
Yeah, no, to your point, Julie, it's been a big week for international news, and I still don't think the market is understanding it or pricing in. You have global coordination, global tightening underway, and these markets continue to ignore it, and perhaps that will become a moment of reckoning very soon.
Yes.